Live from New York and London, I'm Vonnie Quinn.
And I'm Mark Barton. This is Bloomberg Markets on Bloomberg Television. Right, time for Futures in Focus. Gold pairing, modest early gains, US dollar rallying, lingering tensions in Catalonia weighing on the euro today. Joining us now from the CME to discuss, Bob Iaccino of Path Trading Partners. Bob, good to see you. You're medium-term bearish on gold. Why is that?
I think gold is flipped, Mark. I think when you were looking at gold a couple of weeks ago, trading above 1,200 or 1,300 rather, and actually the resistance support balance really comes in at 1,298, but people look at 1,300 because they love those round numbers. As long as we're below 1,298 on the price action picture, then you have to sell rallies in gold, and there's significant resistance up there. You look at the fundamental picture of it, there's really no adjustment in supply and demand in gold. All we've seen is the pricing of gold based on the stronger dollar turning around on us and the geopolitical headlines at least calming. I don't believe the North Korea picture has gone away, but it seems like pressure to ratchet down the rhetoric has started to take some effect. And as long as those headlines are out of the news, they're going to sell rallies in gold.
And Bob, is the dollar going to hold on to its gains or not? I suppose it's a short-term versus a medium-long-term call, isn't it?
It is. Short term, I think we're kind of steady as she goes. To me, the Fed is actually starting to convince the market that whether the economy needs the rate hikes or not, they're going to do it. You've seen the CME Fed Watch tool in terms of the probability of the December rate hike go up above 80% now. It was 46% 2.5 weeks ago. And then you look out to March of next year, and we bumped up to 25% of an additional rate hike there. And obviously, the diminishing of the balance sheet is going to begin or has begun. So the market is actually starting to believe this. And when you look at the dollar index, there's quite a ways to go. Over 6 months, we're still down over 6.5% in the dollar index. So there's plenty of room for it to run. Short term, I think it's steady. Medium term, I think would grind a little bit higher.
How much attention are you paying to all this chatter, Bob, about who might be the next Fed chair?
Quite a bit, actually. I mean, when you look at Kevin Warsh, you're looking at someone who is not an academic, a little bit out of the mold of the last few Fed chairs, but is definitely considered to be pro-business. And is he an interest rate hawk or dove? We don't really know yet. I think he was definitely sided with Ben Bernanke most of the time, although voiced some opinions to the 2010 version of QE versus the original QE. So it's going to be, that to me is the one to look at. The rest of the candidates, I think, are the traditional mold, and we'll just sort of continue along the path of Janet Yellen. But it seems pretty much assured today, could change tomorrow, pretty much assured it's not going to be Chair Yellen.
Bob, quick comment on oil holding below 50. We had the export data yesterday from the US. Flip side, we had Putin speaking. Looks like it's definitely an option. The production cuts could be extended next year, next March, when this program comes to an end. How are you feeling? Where are you? Are you more bullish or are you more bearish?
Mark, I think this is also short to medium term. Short term, we're stable, we're neutral. They've achieved stability in the price of oil, but oil does not stay stable for very long. Longer term, I'm bullish. I think the Saudi Arabia trip to Moscow is a big deal. I think the production cut is going to be extended. They're just not going to talk about it till January, as the Russian oil minister said in Abu Dhabi 2 weeks ago.
Bob, great to see you. Bob Iaccino there of Path Trading Partners with today's Futures in Focus. Vonnie.